Hi, my name is George Dagnino. I'm the editor of the Peter Dack portfolio since 1977. You can find information about my work on www.peterdack.com or otherwise on peterdack.blogspot.com, which is my blog. On this presentation, I'm going to talk about timing ETFs. This is a simple model, which I'm pretty sure you will find it very useful. The outline of this presentation is the following. First, I'm going to give you the objective of the model. Then I'm going to show you what are the ETF that were used in the model. Then how much was invested, the initial investment in each ETF. Then this is a model based on moving averages, and I will give you the length of the moving average that was used. Then how the buy and sell signals were generated, and then of course at the end I will review the performance. We ran several models, and the one we chose is the one that minimized the drawdowns, that is how much you're going to lose at some point in time, and minimize also the volatility. And on the other hand, we are trying to obtain satisfactory returns, that is outperforming the broad market. The ETFs used were XLP, which is the staples, XLY, discretionary, XLV, healthcare, XLU, utilities. Instead of using cash, that is short-term money market, we use TIP, which is the inflation-protected bonds, short-term. We are going to assume that we invest 25% of the capital in each ETF. And by the way, this is the maximum amount that is invested in each ETF. Either you invest 25% when there is a buy, or when you sell 25%. So that is the trade that can take place. The moving average that we are going to use to establish and determine the buy and sell is for each ETF is the moving average is the 150-day moving average, which is computed for each ETF. A buy signal is generated when the ETF rises above the 150-day moving average at the end of the month. The money comes from TIP when is a buy. A sell signal is generated when the ETF declines below the 150-day moving average at the end of the month. The money goes into TIP. We have run the model from January 2007 to March 2012, and this is the performance of the model. The return of the portfolio was 42.5% during the period. The maximum drawdown was 21%. In other words, the most you could have lost was 21% of your capital. The number of trades were 57. Had you kept the S&P 500 during the same period, your return would have been 7.9%. And the S&P drawdown was 55.2%. That's the maximum you would have lost had you held the S&P 500. Thank you for following this presentation, and I sincerely hope you found useful how moving averages can be used to time investment in ETFs. Much more can be found, of course, on my website, www.peterdack.com, or if you subscribe to my service, the Peter Dack Portfolio. Thank you, and I'll see you really, really soon. So long.